Let's connect with Devina Mehra. Let's take our conversation forward, talk about the global linkages, the rally in metals, and how should one read into what is happening on the geopolitical front. Devina, good morning. I know we've caught you in wee hours, but how are things? Hope all is well with you in Dubai.
Yes, it is. And UAE is the number one performing market of the globe year to date. So from the market point of view, also UAE is good.
So UAE and India is the second best performing market. So think about it. You have presence in both. You have presence in both the markets now.
India is not. India small cap is. India small cap is, I think, number 2 or 3. India itself is. In fact, that's the remarkable thing that every year the leadership in the globe has been changing, but India has been pretty steady. Last 3-4 years, I was looking at it as like number 19 in one year, number 21 in another year. Right now, in dollar terms, it is 18, I think, with 12 and odd % on the Nifty. Of course, in rupee terms, it's 14 plus. But even so, I mean, UAE, for instance, is more than 50%. Vietnam, I think, is 37%, and so on. So it's still a long way off from being the best performing. But small cap, yes.
The hallmark of First Global always has been that you believe in the power of cycles, which is that everything that goes up has to mean revert, and everything that is down has also got to revert to the mean. What is next for us now that we've seen a formidable comeback in small cap stocks in India and a good steady outperformance by US tech stocks? What is next for us now?
If you're looking at from a zoomed out kind of view, the thing to remember is in any of these things that, if your question is that, is it close to the danger level? I remember during the monsoon, when as a child, one used to listen to the All India radio news, and it used to be that Yamuna in Delhi is so many meters below the danger mark, and so on. So if the question is really about the danger mark, we have this, what we call the lake of returns theory, which is that it is only when the markets reach a danger point can you say that there is danger of overflow and flooding. So if you look at the Indian market, yes, it has gone up a lot. If you look at from the March lows last year, but if you again step back a bit and see over the longer term, if you look at let us say 10 years, 15 years. So if you look at, I was looking at this data at the end of 2019, and all equity markets or equity mutual funds for that matter, for 10 years had given less than fixed deposit returns. So you were talking still of 5-6% return. Yes, with this big rally from the lows, as I said, you can see the returns have gone up. But if you look at a longer term perspective, we are still way above what the long-term average for the market is, which is between 13 and 15%. So, and also small caps, the same thing that yes, this year they have been great performers, but longer term, if you look at, again, that was coming out of a big bear market. So it is still nowhere close to the danger mark. So danger mark means that a prolonged bear market. Yes, there can be corrections there after a big run up, that often happens. But if you look at a very sustained bear market, right now the danger signs are not there for that.
What would be the danger signs? Would it be valuations? Would it be interest rates? Would it be historical returns? What would compel you to say that, look, markets have peaked out or they're about to peak out?
See, as you know, Nikunj, I never make like Nifty projections. So, what we are focused on always is the stocks, the sectors, and the view on that. And even there, we say be bearish. So, never be permanently bullish or bearish. Change direction if signals change. So, that caveat is always there, that this is how it looks just now. But you have to be careful, and not the least because the macroeconomic indicators, I think, will take a long time to get completely sorted out, and which have an impact at least significantly on the large cap space. So, to that extent, you have to keep that in mind, that the economy is still hurting, businesses are still hurting, people are still without work. So all of that will definitely have an impact on the earning stream of a number of companies. So the return part is one part of the story, but definitely, I mean, there are enough things to keep an eye on. Interest rates per se, both in India and, let us say, US, which sort of sets the stage for many others. Some of the, just to give you context, some of the emerging economies have already been raising interest rates, but I don't think that's an imminent danger either in India or in the US, because the central banks will try to keep the interest rates low. And I mean, this Fed statement of that we will look at tightening or whatever, next year, year after, all that is a meaningless thing. That it has no meaning at all. And in some senses, by the previous taper tantrum, when Fed tried to tighten earlier, the market has sort of has the Fed in its grip, that if you try to change the easy money policy, we are going to fall, and then you'll have to again roll it back. So I think right now, as things stand, many central bankers are in a bind. And even Europe, I mean, so I had tweeted about it some time back, that when we were growing up, the whole image of, and that was the truth also, of the German central bank, Bundesbank, used to be that they are extra careful about inflation, and they'll do just about anything to prevent inflation. But today you have inflation in Germany with negative interest rates for the bank depositors, and still the easy money policy has not changed. So, something fundamentally has changed with the central banks of the world.
Indeed. Devina, hi, morning. You've always at First Global said that avoid scars at all costs. And scars, by here, you imply single country, single currency, single asset risk. Now, for those who are looking at just the India market standalone and wanting to ride the trend, they're fully and overexposed to just equities as an asset class. What is your piece of advice for those who are wanting to ride the trend?
Hi, Aisha. Good morning. And my advice always is to diversify. So don't have all your eggs in one basket. That's always very tempting when things are going well. I even have that, at times people say that Indian market is doing better, so should I have any global exposure at all? So that works even for people who do look globally. But all statistics show that when you are chasing whatever is the in asset class or in geography, you are likely to have below normal returns. I mean, that's the statistics, because everybody tries to jump in when you've already seen the performance. So definitely at this point, I would not say be totally and overly exposed to equities. So do have other asset classes in your portfolio always. And number two, I would say that also, I mean, I spoke about small cap earlier, but with small caps also, always with, even when you have a bullish stand on small caps, I always say cautiously bullish, because it is a risky asset class, and it is a risky asset class all through the world. I was looking at statistics even for the US market, and in mutual funds, for instance, longer term statistics showed that small cap mutual funds in the US had done better than overall mutual funds or large cap mutual funds. But once you adjusted for the schemes which had gone out of business, either wound up or merged with other schemes, actually the small cap space had not given better returns. So small caps is always, again, a risky space. So I would say, I'm always say that investing is a loser's game. So your first perspective has to be to prevent the big losses. So preventing the big losses means not being overly concentrated in equity and not being overly concentrated in small caps and not be overly concentrated in terms of stocks or sectors. So at least, do these things.
Sure. So how would you bifurcate the pie in terms of percentage allocation, Devina? Because it's no more the traditional asset classes. It's not as clean and simple as real estate, gold, equities, and fixed income. You've got various other, fixed income assets. You've got cryptocurrencies. The pool of, the asset classes itself is so large now.
That is true, but I mean, the broad classes don't remain that very different. I tend to bias towards liquidity. So that's also part of managing your risk is, so, by nature, we always concentrate on liquid markets. So not just exchange traded, but for instance, I will tell you that in our funds, we have less than 10%, just about 10% in small caps, which is below 5,000 crores market cap. So liquidity for me is number one. So real estate, I think, normally, unless you are in that business, you should have your own home and not much else more than that. But fixed income, yes, you should have. And also gold, you can have some, because gold is a asset that suddenly wakes up. I mean, there was a whole phase from, I think, 1980 to 2003 when gold did nothing, and then suddenly it had a big boom. So that's, and Indians anyway like to hold some gold. Crypto, I think a lot of people are jumping into, which means they are taking way too much exposure than should be taken. I mean, we have done an analysis. It is extremely volatile asset class. Adding a sliver at times improves your returns. So, but sliver for us means 1 to 3% maximum. So it's not something where you should have, 20% of your portfolio till the asset class itself stabilizes and is, no longer so volatile. But exact percentages depends on your objectives, depends on your stage of life. But as I said, that in your pie, you must have, or your pizza, you must have slices from everywhere.
All right. Hi, Devina. This is Mubina as well joining, and I think this was some good, guidance to all of our retail investors as well on how they can construct a portfolio for themselves. Devina, I want to talk about a tweet that I read recently from you about how, there has been a plethora of unicorns emerging in India. Like you mentioned, I'm going to quote you, that every day there's a new $1 billion IPO that's being announced. And, investors are investing in these companies. We've seen subscription numbers in Zomato go through the roof. We are expecting many more, Nykaa, Paytm, etc. Now, I want to know that when you say, will it kill the golden goose? What exactly do you mean by that? And how are you looking or approaching these new age tech companies, given the fact that, you do have tech, by the way, as one of your second largest holdings?
Yeah, of course, that tech and this tech is quite different. So we do have, you're right, that one of our large exposures is to IT services, relatively speaking. I mean, we never have outsized exposures. But IT services is a whole different kettle of fish from these new age IPOs that you're talking about. And IT services, in fact, I mean, just to give you context, we had identified last year when FMCGs were very much in fashion, and I looked at IT services and said, these are companies which have very good returns, fairly steady, predictable, all those things which are said for the FMCGs, yet the valuations are way, way below. Plus, of course, in an uncertain environment, their growth was a little more certain, and also they gave you currency protection. So that's a different kettle of fish. Coming back to the tech IPOs, as far as the market is concerned or the companies are concerned, I think this is like great news that the Indian market is ready to look at companies which are not in the conventional mode of looking at same parameters of EBITDA and ROE and all that, and you're looking at loss-making companies, and it is good that these companies are able to list in India rather than list anywhere else in Singapore or NASDAQ or so on. But as far as the investors are concerned, as I said in that tweet, maybe it's a negative to have too long a memory, but you remember previous IPO frenzies, and right now, of course, being a good time for companies, one after another, they are filing the DRHPs, or one step before that, they've started the process. So that is scary. And also, what valuations do you give to these companies, even if, there are two things. One is on the valuation, but even if you leave aside earnings, even on a, let's say, price to sales basis. The other is that most of these companies are in the mode of being loss-making. So while going into an IPO, you try to reduce this loss, which means that there is pressure on revenues and on market share, which you would have seen in both Zomato and Paytm, for instance. So, whereas on the other side, you are competing with players who are still not in the public market, and so they have VC money to burn. So it becomes a kind of a little bit of an unequal race. So that's one other concern area. That doesn't hold for everybody. Nika never went into a discount model, so a heavy discount model. So that's profitable. And Falguni was a year senior to me at IIM. So proud of what she has achieved, definitely. So that was, so that's it. But also let me also tell you what is the sort of negative to going in with profits, which is that once you have once you have earnings, you have a benchmark PE. So that also that's a different thing. But overall, I think a lot of investors are jumping in, investing in what they think is the IPO process rather than the company. That, whatever comes in, there's this frenzy. If I get it, I will get a chance to make some money off it. That becomes a risky enterprise. I always say that, don't be into FOMO, that if this bus goes away, there's always another bus coming along. So great for them, as I said, great for the companies, great for the markets, but some caution advice for the investors. Also, if you look at global listings, Zomato had parallels like Grubhub or, Uber Eats, which is part of Uber, or DoorDash, and those experiences internationally have not been great in the listed market.
Well, yeah, naturally. These companies are a totally different ballgame from what we look at our traditional tech companies and, the software and services oriented companies. And yeah, I think we very soon have to include a whole lot of new jargons in the world of financial parameters if we have to get to valuing these companies and, assessing their performance. The other point I wanted to talk to you about is India's whole Atmanirbhar, outlook. It's not just an India thing, by the way, it's a China thing too. China too is now looking at first catering to China, and then perhaps if something is left over, serving it to the world. Of course, the likelihood of that happening is very low because, again, they want to now cut down on production. The priority is basically look at China first. That's the case, by the way, with Japan too. So all over the world, we are looking a little more inward. How do you see opportunity opening up for India and perhaps other markets as well as China starts to look inward?
Yes, you're right that Atmanirbharta is now not only in India. Nehruji's self-sufficiency seems to be the flavor of the month, partly because so many supply chains were disrupted around the world. So US itself has had a policy document saying which are the industries where they want to control the whole supply chain, or where they want to invest more in those industries in US, even if it is, so you're moving from a very, very flat world where you wanted to source from wherever something was available and have just-in-time inventory, to a place where you want to control the whole thing, and all these, whether it's China, US, etc., even EU for that matter, the governments are willing to invest in it. So China has had 2-3 major things. One is that there are certain industries, and especially high tech and innovation. So right from neuroscience to semiconductors, the Chinese government wants to invest in that, and they are also moving to more state control than was the case earlier. So that's a different thing. But I mean, it is not as if for the low tech products they are saying that we don't have capacity for the world. So that I don't think is happening. So there's no reason for us to assume that China will suddenly withdraw supplies from the world. That's not what they want, but for themselves, they want the entire supply chain. But I mean, not what China wants, but what the rest of the world does want is more suppliers other than China. So they want to reduce their dependence on China. And that's been the case not just today. It's been there last at least a couple of years or a little more than that. But unfortunately, I don't think India has really, barring, some isolated pockets here and there, like chemicals and now a little bit on the API side, that India has not taken enough advantage of that. Many other countries, Asian countries like Vietnam, Bangladesh, various others, moved much faster on that, even though India logically should have done a lot more. So I think we can do much more than what we have done in terms of being a China, instead of China supplier or a China plus one supplier. Definitely that's an opportunity, and I hope more Indian companies take advantage of that.
So, Devina, let's say if one makes a basket of 5 top consumer companies, Nestle, HUL, Britannia, the obvious ones, and one makes a basket of 5 top consumer tech companies. It's one Zomato, but soon it could be 3-4 more, Policy Bazaar, Nykaa. On a 3 to 5 year basis, do you think the traditional FMCG basket or the new consumer tech basket, what will outperform?
You're talking of two different ends of the risk spectrum, first of all. You're talking to completely different ends of the spectrum. And so highly risky means you don't even know that of the second basket, how many will be real survivors at the end of 3 to 5 years. And even for companies which have been around a long time, I do not like to make 3 to 5 year projections. That's the whole point of being bearish, that you don't know. I mean, I'll give you an example from another country, China, for example. The tech giants like Alibaba, Tencent, they were big outperformers, big absolute gainers for us last year. But then things began to change. First, it happened with that Ant Finance issue for Alibaba, which, that was the Alibaba affiliate, which right at the last minute, the Chinese government clamped down. And then it happened with a series of other tech companies, it began to happen. So you could see that China wanted to cut down these tech giants to size. So from being a 10-11% in China in early this year, we are now down to a couple of percent, or I think a little lower than that, and that too no tech anymore. So we don't like to hold long-term views and just cling to that. As against that, I was talking to a large international bank, and they said, what's your rating on Alibaba? This was, I think, when Alibaba was just over 200. Now it is, I think, at 180 odd. And they said, we have a buy. And they said, what was your rating when it was nearly 320? Said it was still a buy. So you can have a buy all the way down. And now that at $200 or $210, the target price was $300. So you've gone through that price, come down, and you still have a buy. So that's not the way to look at it. And especially for these new consumer tech companies, as you're talking about, where the uncertainties are much, much higher. So you have to see how it pans out, because new players come in, market shares change, many changes happen, and you right now don't even know what that 5 basket is, because they have not even been listed yet. So I don't think, you can really compare it with companies like HUL, which have been around 100 years.
Answer that, don't get excited with what is happening in terms of stock prices. Let's talk about next 2 to 3 years. Now, we heard from the Prime Minister in terms of making India a better source of energy. ESG is the biggest theme which is now being talked about both in boardrooms and also in investing rooms. How can one benefit from this mega trend which is more compulsive in nature called ESG?
Now, you have to be careful that you are not getting caught up only in the buzz, because many of these things, there are announcements and what would be, the right noises, I would say, on part of both governments and corporate. So you have to look at what people are actually doing on the ground and how much of a difference will that make to the output of what they're doing in terms of the revenues, profitability, because also it means that at times that by opting for that, you might be giving up some profitability. So you have to look at or you might be a supplier to these kind of businesses, which is a different thing. For example, while we have cut down on China last month, our two top performing companies were Chinese companies in solar energy and energy. So there is opportunity there, but you have to see what who's able to actually implement things, who's actually able to make some difference to the actual output rather than just making the right noises. So in terms of investing communities moving towards ESG, I think that's still early days for India.
Okay. Devina, great to have you on the show as always, and thanks for this extremely lovely and candid chat.
Thanks for having me. Great speaking to all of you.